Welcome to the Fintech Times News and Views podcast. Established in 2016, the Fintech Times is a global multimedia news outlet centered around the world's first leading fintech newspaper. We report on the latest and brightest ideas from the fintech world. Follow the conversation using hashtag TFD News and Views and follow us at the Fintech Times. Hello, and welcome back to the Fintech Times News and Views podcast. Tom, Francis, how are you guys doing this week?
Yeah, we're doing pretty good. It's been a busy week this week. I feel like I say that every week, but it's been another one. Pretty standard this week. We've just been getting through the news, had a lot in our inbox, and we've got some more interesting things to talk about this week.
Great stuff. And Francis, how are you?
Yeah, I'm not doing too badly. I think it's always fun when we have a lot of exclusive articles that we're working on, and we've had a good few this week. So, yeah, it's been fun.
Yeah, definitely. I think as well, because it's coming up to the end of the year. There's so much everyone wanting to give their comments on like the thoughts of the year and like predictions and stuff like that. It's truly prediction time. So that's very interesting at the moment. But great to be chatting about fintech with you guys once again. What articles are you going to be bringing to the table this week, Tom?
This week, I'm going to be talking about an article that's talking about new findings from MoneyHub, which found that savers with workplace pensions are much less likely even to engage with their pensions compared to those with private pensions.
Fantastic stuff. And Francis, what are you going to be talking about?
So this week I'm going to be talking about alternative finance and how it acted as a lifeline for 70% of UK SMEs.
Awesome. And then my piece this week is on how challenger banks are enabling the most authorized push payment fraud in a new PSL report. So a nice little variety of articles this week. Does anyone want to go first? I'll take volunteers. I'm going to volunteer Tom because you smiled first when I asked.
I'm in. That's what I was volunteering with a smile. So let's go. As I just said, basically, MoneyHub has found that savers with workplace pension schemes are significantly less likely to engage with their pensions compared to those that have personal pensions, maybe freelancers, things like that. And basically, it found that 25% of savers with a workplace pension never check their pension pots, while just 11% of respondents with self-invested pensions and 10% with self-employed pensions say they have never checked their pension. So there's a far less proportion of people with personal pensions that aren't checking, sort of where those levels lie. And in light of this, MoneyHub basically explained that it's concerned because savers with workplace pensions typically have less understanding of the funds that they've set aside for later life. So savers with workplace pensions, I feel like I'm saying workplace pensions too many times, often know less about engaging with their pensions and navigating their accounts. And an average of 14% say they would not know how to check their predicted pension income, with this falling to just 5% for those with personal pensions. So taking these findings into account, MoneyHub is basically calling for people, whether they have workplace pensions or not, to engage with pensions dashboards, one of which it offers itself, or to engage with the eventual government pensions dashboard, which continues to receive a number of pushbacks and still isn't ready. But basically, off the back of these findings, what I really wanted to ask you guys is, given the fact that people with personal pensions seem to be much more engaged with them, is it just down to people needing to put more time into understanding their pensions, or do you think this is just another example of the government failing to act quickly enough to support people? So Francis, I want to get your take on this first.
Yeah, cheers, Tom. I think it's always it's a bit of both, right? I don't think there's really one that's more important than the other. And I know it's a bit of a cop-out answer to say that, but I do think people need more support from the government and from their employers, really, to sort of bring more awareness and the importance of understanding your pension. And I mean, once the government's dashboard that is comes into play, I think that'll be a huge help, and sort of it will bring a lot of awareness to just workplace pensions in general. But I do think that more does need to be done from both an employee's standpoint and from an employer's too. So I think what I took away from the article, at least, or what I really liked, was MoneyHub's personal finance technology dashboard platform that they're offering, which is sort of acting as the intermediate. It shows savers how much income they can, or intermediate, while the government dashboard is being made. It shows savers how much income they can expect during retirement based on current savings and spending levels. And I think that's really cool, just because it really highlights, it almost puts something that you don't really think about. You just think about, oh, pensions in the future, I'll have some money for when I retire. But then this actually puts it into a very digestible amount of information of, this is how much income you can expect. And then that, I think, helps people think, oh, I need to put a little bit more in, or this is just enough. I think that's really helpful in really what these dashboards, yeah. And I think that it is really helpful in that this is the point of those dashboards and what they should really help people do.
Yeah, I agree. I think Money Hub's offering does seem to really fill the gap that the government pushing theirs back has really left open. But I think one thing that I've been kind of wondering when I was looking at this article and the findings was, I wonder if maybe whether the government's pensions dashboard, when it finally comes to fruition, whether people will actually use it. I think it's one of those things where we'll have to wait and see. But I think personally, I'd like the option to engage with it, but it's purely down to how seamless it is when it's released, and how much information it really gives people. But I wonder if it could be released and people look at it once and go, "Oh, that's cool. I'm predicted to get this much in my pension," and then never go back on it again. So I think it'll be interesting to see whether something like that will really help. But I think what these findings really showed is just the fact that maybe people need to be spending a bit more time with the resources they currently have to try and work out where their pensions sit, and whether they need to act on improving that. But Polly, I see you nodding. What's your take on this?
No, I'm agreeing with what you're saying, man. I'm picking up what you're putting down, to speak as a youth. I think my kind of big thing that I just want to add to everything that you guys have already said is that I think the problem is that there is a huge disconnect between you as a person right now in your career, and then like in 40 years time when you're going to need a pension. I think it's really hard to envisage that, certainly as I'm in my 20s. Like, it feels so far away, and especially when they keep putting like the retirement age back and back and back, the thought of retiring and needing a pension just feels almost like fake. You know what I mean? It doesn't feel quite real because it's so far in the future that actually you kind of feel like you don't need to think about it now. And I think that's the problem, because you're being told that you have to save for your future when that just feels so far away, or when you can have the £40 a month now. And obviously, like, auto enrollment is a thing. I think that was a really great step for savers and like retirement funds, and that was a really important thing. But that's almost even increased the disconnect, because now you literally don't have to think about it. You get auto enrolled into a pension. You just get an email when you start a new job saying you've been auto enrolled into our pension, and that's it. And then I guess if you look at your payslip, you'll see the money coming out every month, but there's no connection there. There's nothing you have to do. So it's kind of, even though auto enrollment was such an important thing in order to get people into pensions and get people saving for their retirement, actually, I think it has also had the side effect of increasing that disconnect, because you physically do not have to do anything to it. And I think, obviously Money Hub here is saying, like, people don't check their pensions, people don't check to see their growth and stuff like that. And it's like, well, because they kind of don't have to, because auto enrollment is doing it all for them. And obviously that is, I think, where the problem lies. And I don't know who can fix that. And I think that's an interesting question. I don't know whether it is the government that should be working more to doing that. Obviously, I think the pensions dashboard would possibly help. But like you guys were saying, are people going to use the dashboard when it comes? I don't think, would the general like layman person even know what it was? I think that's an interesting one. So I think we're all putting a lot of stock in the pensions dashboard when it finally arrives. But actually, is it going to be this magical thing that everyone says it is? I don't know. But then on the other hand to that, I'm not sure whose job it is to help improve this disconnect with pensions, whether it is the government, whether there's more like financial education like we love talking about, or if it is like the companies like Money Hub and other places to try and help provide you with like an overview of pensions and like sort of your retirement funds and things like that. So I think it's a really interesting topic, and one that I don't personally know the answer to. But yeah, I think it's hard to get, especially I think with the state of, you know, the world and the economy is at the moment. I think it's hard to get people to care about 40 years in the future when right now is a bit dicey. So I think that's the main problem.
No, I agree. I think we can all be guilty of, we see the money coming out of our account and we go, that's fine. And for me, I think, oh, there's not a lot of money in my pension. But then I just think, well, I've got so long until I retire. That's going to climb up. And hopefully in 20 years' time, I'll be earning a lot more anyway. I'll be putting way more money into my pension. So I think it's very easy to put down to, it's not looking great now, but in the future, it will kind of sort itself out, or I'll be in a different situation. I'll be able to sort it out then. And when that time comes, if that's not the case, then that's when you start worrying about it. By that point, it's too late. So I think you're right about the disconnect. It's very interesting. The point actually that, you know, it's an odd time, especially in your 20s, to be thinking about it. It doesn't feel real in an odd sense. It doesn't feel like, whatever it's at now, it's not going to be where it's at in 4 years' time. So I don't need to worry about it. But I think that just shows that how much they do need to push the pension dashboard. You know, if it ever comes to light at this point, it feels like it's never going to anyway. And how much they push it and how much functionality they actually include in it. And I think it's just another example of, we need to see a lot more effort being put into this. And hopefully all these pushbacks mean that it is a fantastic product when it finally comes out. But knowing how these kind of things go in the past, I don't know, it's got a sense that it might be lacking, or they might not push it enough to really make a difference to, as you say, the average person. So it's an interesting space, and hopefully we see some developments in the near future.
Yeah, absolutely. Excellent stuff. Francis, I'm going to make you go next. So take it away.
All right. Well, fair enough. Can't argue with that. So, my article this week is going to be on alternative finance, as I mentioned earlier. And I always find sort of alternative finance, alternative payments, stuff like that really, really interesting, because it really embraces this idea of the digital revolution that we've been hearing about for so many years now. And I remember once we had the podcast, and I think it was with you, Tom. I think you were already on it at this point, but we were talking about payment options, and this is just a slight tangent from my article, but I thought it'd be just an interesting recap, shall we say. And it was just talking about alternative payments, and when you're at the checkout point and you're offered crypto payments, debit card payments, credit card payments, all these different types of payments, BNPL, stuff like that. And then I remember saying that I thought it might be a bit too overwhelming, but then you guys were like, "Oh no, the more options you have, the better." Like, if you want to use cash, that's still an option. So I think it is, and I will admit that in hindsight, you guys are correct. I think it is a thing of the more options you have, the better. It might be a bit overwhelming, but I think that is on people to really take notice and try and explore and see what options they have out there for them, as there might be something that works better for their financial situation. But again, I said there was a bit of a tangent, but I just thought it was interesting to really talk about alternative under the umbrella of alternative finance, because then we come to this topic today, which is obviously alternative funding. And I think this article was really interesting for a variety of reasons, but it was interesting to see how many businesses were able to survive as a result of alternative finance, especially when you consider how many new businesses were started up in the pandemic. What was it, 3 years ago now? And although some of them remained small and it was like a side hustle, some of the organizations that were created during that time period, they had big aspirations. And I think it's really important to see how they were able to get the funding to survive. And although we are a few years on from the pandemic now, I think it's interesting to think about why lending from traditional banks has dropped by almost half, from 7.6 billion to 3.7 billion pounds. And I think it's quite a shocking, a drastic drop, really, in just the space of 2 years, to have financing drop that much. And I think that's one of the things I wanted to discuss with you guys is kind of, why is this? Is there a reason for it, do you think? And I think as businesses demand more from the government in terms of guidance, I think it's really cool to see fintechs stepping up and sort of filling the funding void. as aspiring businesses who are searching for funds are able to survive and sort of put their offering out there for everyone. And I think that is really cool, and sort of it shows, like I was talking about that sort of digital revolution before, and it's this idea of, I almost think, digital supporting digital, and I really like that idea personally. But it is really cool when you see what this money is going towards, because it goes towards creating business processes such as cash flow management and transactions, and those things are extremely core to a successful business. So yeah, I just wanted to get your guys' thoughts really. And does it surprise you that funding from high street banks has dropped as much as it has? And does the current economic climate really have a part to play in that, do you think? Polly, I'll go to you first.
Yeah, I think it doesn't surprise me at all that alternative lending, and not high street bank lending, has kind of increased. I think, like you're saying, it's really difficult for small businesses to sort of navigate certain challenges, and one of those challenges is access to funding. And I think, as we always say, having fintech fill a niche, and like you're saying, filling a gap in this instance, I think is the perfect example of fintech and how it can help. And obviously it can help by offering like lower cost products, or anything like that, anything that an SME can actually get on board with and go, yes, this lending product is for me, is perfect. And I think it's a really difficult situation to be a small business right now, and with the cost of living crisis, and we're going into winter, so I think a lot of people are worried about like energy bills as well. And I think you see all the time like small businesses are dropping like flies, and I know where I live, it feels like every week someone's making an Instagram post saying, sorry, we're closing. So anything that can help that and help with that, I think, is great. And that's where like alternative lending come in. Like, it's literally challenging the traditional funds and providing alternative services to small businesses that maybe can't access the traditional lending. And I can't see how there's a problem with that. I think it is a fantastic thing, and it's a fantastic resource. And I think for small businesses, it literally provides a lifeline in certain situations when things are a bit dire, but also it provides the opportunity for a lot of fantastic other things, like to grow, to like really expand their business. And I think that's the importance of having these alternative lending streams. And it's no surprise at all that small businesses are turning to these alternative lenders.
No, I completely agree. I wouldn't be surprised, to be honest, if we saw more established organizations as well really sort of looking towards alternative lenders because of the offerings that they have. And I just think it's kind of like you said, when you have to jump through so many hoops to really get that access to finance, it seems almost not pointless, because it isn't pointless, but it seems a lot more difficult to. It's like, why would you take the difficult route if there's a simple route that gives you the same end product, really? So no, I'm definitely with you, and I think the only thing that I can really think about in terms of risk is more for the lender really than it is for the business itself, because if the lender, there's got to be reasons why these traditional banks aren't financing these new organizations, and that's because there's probably a lot of risk associated with it, whether it be that they don't think that the company can pay back the loan, or whatever it might be. I do think that there is an element of risk for alternative lenders as they sort of take these chances. And I don't know, it does make me wonder if there is if they're running like a really fine line between just making themselves go bankrupt. I mean, I'm sure there's more in detail solutions which sort of avoid that from happening, but I did think that was an interesting point as well to sort of really consider. Tom, what are your thoughts?
Yeah, I think one of the recurring themes that I've definitely seen over the last couple of years is like the lack of support coming from the incumbents, given the rise in interest rates that they're implementing into their lending. They've just become a much less attractive option as well. Like, if these SMEs are seen, oh, I can go to the traditional bank to get this lending, or I can go to the fintechs that are lending to them for a better rate, then this a no brainer really. They're going to pick the fintech that's able to more quickly adapt to the macroeconomic conditions, whereas the traditional banks are able to pivot much less easily, and keep their offering competitive. I think that's one aspect that maybe is a bit less easy to consider. But I think also the idea of open finance is something that could have a big impact on this space. Fintechs are able to take into account data that traditional banks aren't. So where traditional banks might see a lot of risk associated with lending to an SME, fintechs with access to different data are saying, well, actually, this isn't as much of a risk as traditionally it would have thought to have been, and therefore we can lend to them, and that's an interesting area that they can enter that the traditional banks aren't yet, because they haven't implemented this kind of data into their risk assessments. So I think it just goes to show that innovation is once again leading the way, and I think certainly in this sense it seems as though obviously banks have made it much more difficult to get lending from them, but that is because they're maybe not taking into account the right kinds of data, and that's why fintechs can really take advantage of this space. So I think it's an interesting time, and hopefully one that really forces the traditional banks and the incumbents to take notice and to implement this kind of open finance technology into their offerings. So we see a much fairer and competitive space that in turn benefits SMEs and helps more and more of them to not only survive but to start thriving.
Yeah, absolutely. I think that's a really interesting point as well. Is that it's not that the SMEs are necessarily picking only whatever's available to them. Some of them do have the option of traditional financing and are still choosing the alternative lending route. I think that is a really, really good point, and it's sort of I kind of just want to hark back to what I said before, really, which is this idea of digital helping digital, right? And that, like you said, it's the like the use of open finance. It really is a prime example of that, and is how fintechs are able to really offer a better rate for organizations. But yeah, no, I think it's definitely a space to keep an eye on. So, Polly, we'll go to you for the final article of today.
Awesome. Yeah. So we're going to be ending on a little bit of fraud. And in this story, challenger banks are found to be enabling the most authorized push payment fraud from a payment systems regulator report. So essentially, this report is all about authorized push payment fraud, and it's had a look at the 14 largest banking groups when it comes to victim reimbursement and the amount of money sent from each payment firm as a result of app fraud. And it found that of the UK's 14 largest banking groups, they were in the top 20 highest receivers of fraud. And they basically are a lot of fraud is happening. So an authorized push payment scam or fraud is essentially when someone is tricked into sending money to a fraudster posing as a genuine payee. So I think this is a very real, tangible type of fraud, if that makes sense, when we're talking about here, because this is stuff affected by literal customers and in a way that's probably quite emotional, for want of a better word. Like someone is kind of tricking you into sending the money, whether it's a person impersonating like bank staff or like just someone tricking you into like paying for goods or services, things like that. So I think it's a very sort of tangible, realistic type of fraud that affects quite a lot of people, and 239.3 million pounds was lost to these scams in the first half of 2023, which is a lot of money, and it is quite a serious issue, really, because like I said, because it's affecting real people. Not that all fraud isn't serious, but this in particular I think is something that I think, at least I know quite a few people that have been affected by this, mainly my grandparents, but that's besides the point. And this report I think was quite interesting to see how challenger banks were not helping, but like the fraud was happening within challenger banks. And I think it's definitely a bit of a wake-up call, at least it is according to a few industry leaders, for exactly how payments fraud is affecting the industry. And I guess I wanted to kind of talk about it today to you and say, what needs to be done here? What do you guys think is the solution to helping reducing this kind of app fraud? I think, is it something that the FCA need to look at? But then I think when you think about it, the FCA is already doing quite a lot in terms of regulation, and there's a lot of like authentication required when sending a payment, and like you have to confirm that you're sending the payment to the right person. At least you do on my banking apps and things like that. So does the FCA need to be doing more, or is there somewhere else that needs to have a bit of a change? Is there something else that needs to happen to help us to reduce these sort of app frauds and help these scams, stop affecting real people. I mean, Tom, what do you think about this?
I think, well, it's a big question. Where does the answer lie? I think it's a multi-million-pound answer if you can get it right. It's such a difficult type of fraud, obviously, to combat because, as it says, it's authorized. It's you already go through the bank process of, are you sure you think this payment is genuine? You go for all that, and then obviously it's not enough because millions of pounds are being lost at such a rate, and people are saying, "Yep, I know who this is. This is a genuine source. Send them the money." And it's only afterwards they go, "Oh, wait, hang on a second, that wasn't the person I thought I was sending this to at all." So I think it's interesting. It interests me actually that it was challenger banks that were more to fault for this, according to this report. But I think it's an area that all banks, whether they're challenger banks or more traditional, something that they are all struggling with. And I think the introduction of faster payments also kind of made it even more difficult to try and combat this because it gives less time for the banks to try and step in and say, well, this actually isn't actually who you're trying to send the money to. So I think it's a really interesting thing. And I think the only thing that I can think of that could help reduce it, at least in the short term, is just advanced awareness. So we were always talking about awareness on this podcast, definitely about how important it is to the people to make themselves aware. But, all these times where people just send the money and it's done in how many few seconds. There's so little friction associated with sending the money. They say, okay, yep, send it. I've got this text on WhatsApp from person pretends to be my son or daughter. Send them the money, done. And then there's not really any checks going on. And I think for the meantime, it's just having greater awareness. Just a double check in a lot of situations would prove to them, oh wait, this isn't who I think I'm sending the money to. But I think it's a lack of that, a overconfidence of I know who this is. I'm sending them the money. So I think it's not a long term solution maybe, but short term is just doing whatever they can, whether it be government or FCA, to increase awareness and to make people aware of how they can make sure they're sending money to the right person before they actually do. And I think that's definitely the first step that needs to maybe be even more increased.
Yeah, absolutely. I completely agree with that. And I think what you're saying about faster payments is really interesting. And this idea of friction, I think the payments industry has spent so much time and effort into reducing friction in payments, and now it is a bit of a question of, is there not enough friction anymore? Because I think it's interesting when you compare, because I have two banking apps, and one of them you have to like go through about 6 different steps to send a bank transfer. You have to like confirm payment details, you have to confirm who it is, and they get like a screen pops up that's like, are you sure you want to send this? So obviously that's quite a lot of friction. But then I have another banking app, which is literally you pick who you want to send it to, press send, and it's gone. And I think that one always not scares me a little bit, because I'm trying to be confident in who I'm sending my money to, but definitely that lack of friction I think is an issue. And it's interesting to see. I wonder if we're going to be seeing more friction and things coming in these payments that we've worked so hard to get to be quick and fast. But Francis, what do you think?
Yeah, I think you both have raised some really interesting points there about, is there really enough friction and the ease of payments. And I mean, when you were saying that, all I was thinking is, because I think I've fallen victim to this before, to be honest. Like, I tried to buy something on Facebook Marketplace, sent the money, and never got what I ordered. But I think what the biggest problem really is that when you're confident in, or when you think it's legitimate, it doesn't matter how many things are going to come up saying, do you think this is like the real person? You're just going to click yes every single time. I don't think that's really. There's no point having 17 different pop-ups come up saying, "Are you sure? Is this really who you're sending it to?" This, that, and the other. Because if the person is smart, they're probably going to have made it so that it all seems legit and checks out. And then you send it, and at the end of the day, it's still a problem, isn't it? It just doesn't feel like that is the solution, to me at least. And I think I agree with Tom as well in this idea of, it is interesting that challenger banks seem to be the more culpable, the ones who the biggest culprits, I should say, sorry, when it comes to sort of enabling authorized push payment fraud. And I don't know. I mean, I think what I found most interesting from the report was how stark the divide was. It wasn't really a case of maybe challenger bank, incumbent, challenger, incumbent, incumbent, or something like that. It really was a case of nearly all the challengers were found to be enabling more fraud, and it was the incumbents that weren't. And then especially when you look at the volume of how much fraud was being transacted, or per a million transactions, how many were fraudulent, and what the actual value of the fraud was, I think it is really interesting to see that stark divide. And I mean, challengers, it is easier to make challenger bank accounts, right? That is the whole appeal. So is that where the problem lies? Is it that they need to be? Is that where the friction is needed? Even I don't know. Like I think it's a very interesting topic, and it's like Tom said, it is a multi-million solution if you can sort of come up with it. But for the time being, I don't think having more pop-ups at least is the way forward to solve the problem.
Yeah, that's really interesting, and that's an interesting viewpoint. I guess it's something that we're going to have to kind of sit back and watch. But I mean, as we know, we've talked about it so many times. But the fraud fight kind of is never ending, and I'm sure as soon as someone kind of figures out how to start reducing this kind of fraud, they'll figure out another way to make it even bigger. And I guess because there's a human element in push payment fraud, I think that's probably going to be the biggest issue, because you physically as a person have to send this money for whatever reason you think you're sending it for. You still have to send it. So I wonder if there's something there. But anyway, thank you so much, guys, for bringing those articles to the table. Really interesting discussion as always. If you want to hear any more about any news and insights going on in the fintech world, head on over to thefintechtimes.com and you can read plenty more fantastic things over there. But let's very quickly do what I learned this week. So each week we learn so much new stuff, being on the Fintech Times editorial team, so much information is crossing our desks that we thought it would be fun to share that with the listeners. So Francis, what have you learned this week?
This week, I have learned that the UK companies have ramped up their sustainability efforts, and that the number of UK companies developing plans to tackle climate change has increased significantly in the past 12 months, according to Aviva's annual Climate Ready Index.
Fantastic. And Tom, what have you learned this week?
This week, I learnt that over half of the UK's SMEs still rely on credit cards to support their business day-to-day operations. And that's according to a new report from, I believe it's called Grenke UK or Grenk. I'm not sure how to pronounce it too fair, but it's a good report regardless.
Great stuff. And then what I learned this week is that there are almost over 1 million more workers aged 65 and above in the UK labour market than there were at the beginning of the century. So almost 1 million over 65s opting to continue working over retirement, which is analysis from the Centre for Aging Better. But anyway, guys, thank you so much once again for joining me. It has been a pleasure to chat fintech with you as always. And yeah, I'll catch you on the next one.
See you guys next week.
See you then.
Thanks for listening to the Fintech Times News and Views podcast. Don't miss next week's episode and continue the conversation using hashtag TFT News and Views and follow us at the Fintech Times.